Hello, ladies and gentlemen. Welcome back to the FT studios in London for the latest in our series of PWM videos in association with UBS Global Wealth Management. Our topic today is investing in alternative assets rather than traditional stocks and bonds. And I'd like to welcome two special guests to join me who can discuss this subject in greater detail. My guests today are Jerry Pascucci and Johannes Roth, the co-heads of the alternative investments business at UBS.
Thanks for having me.
Thanks for having us.
Clients of UBS Global Wealth Management have invested, I think, around $160 billion in alternative assets, and the bank was recently named as Best Private Bank for Alternatives by PWM in 2022. What is behind this growth, and why is this area a strategic priority for UBS? Jerry, what are your thoughts?
First of all, thanks for the honor. We're very, very grateful to have received the award. For a long period of time, we had a very low interest rate, global interest rate environment, and therefore alternative forms of yield became very attractive. You could say the same about other asset classes and strategies. So conditions were favorable, number one. And then number two, there were some very important structural innovations that occurred in the industry that allowed us to address a far vaster base of clients. And in doing so, obviously, you captured many new entrants to the market. These were clients that needed and wanted these exposures in the past that did not have access, that now could. And so when you combine structural innovations with what was occurring in the global capital markets, that made for a very, very robust period of growth. And then I would just say lastly, how you go about the process of scaling your business for your clients also then allows you to compound that growth. And I think we saw that around the industry.
So if I can bring in Johannes, are we talking about a fixed income substitute or something a lot more broader than that?
So look, I think it is broader than that, but obviously I'm biased. But if I look at the traditional 60-40 portfolio, right, that has been down between 20 and 25% this year, which is obviously not normal. But I think you, as an investor and as a client, you got to assume that if you look at the correlation between fixed income and equities this year, which has been quite positive, that this may or may not continue. I mean, obviously, you had a inherent steadiness in that picture, but I think the 22% or 20 to 25% range says it all. I mean, if you just rely on fixed income the way you have been, it could be quite dangerous. And obviously, in our business, we are in the business of careful and responsible stewardship of our clients' capital. We need to look out for uncorrelated returns, which makes alternatives even more important than in the past.
When your chief investment office makes thematic calls, and of course you guys are very much embedded in this team, can these themes be applied just as easily to alternative assets as the traditional equities and bonds?
Right. So you have an intersection between the themes that originate out of the CIO's office and the expressions that ultimately wind up on the curated platform that emanate from our very, very robust and very, very global investment process. So there are teams of people that are sourcing opportunities and underwriting them around the world in real time, very forward-looking, very rooted in opportunity sets and alpha propositions. And it's the melding of that guidance with the expressions that our investment process generates that results in the quality of the offering suite that our clients ultimately are able to access.
Are alternative assets well placed to be viewed through a socially responsible investing lens?
We at UBS, we have a huge emphasis on sustainability-oriented solutions, right? And impact solutions, we absolutely get that there's a value of the impact that our clients with their money can create. And You mentioned the Chief Investment Office. I think they, in 2020 or maybe even in 2019, already made sustainable investments a preferred solution, which actually paid off quite rapidly. Decarbonization, healthcare, those are mega trends that are absolutely important for us as well. I mean, if you look at things like the EU or in the US, the climate bill, the Inflation Reduction Act, I think that's worth $370 billion. In the EU, we have a program called Repower EU, which is worth $350 billion, which translates, if you think about it, opportunities like green hydrogen production almost to a negative territory per kilogram. And remember, 70% of that happens at the front end, the capex. So solar, wind, hydropower, I think those are aspects in the value chain that will become tremendously important. And this is also being recognized by some of the larger sponsors that we work with.
So we've got some major mega trends here combined with the effective asset allocations. It's quite a positive story. But if we look at the risks and challenges, along with customers of other banks, UBS clients suffered significantly during the 2008 financial crisis due to over-investment in the illiquid alternatives, including hedge funds. Now, is there a similar risk today, Jerry, for alternative assets such as private equity and real estate?
I do think it's a vastly different environment than it was back in 2008. That's not to suggest that these investments don't carry high degrees of risk. They do. They are illiquid. Some employ, significant degrees of leverage. So the last thing I'd say is the advice that's provided to clients today, if you think about the evolution of global wealth management in general, has just evolved so much. If you think of the context in which UBS provides advice in terms of our Wealthway program for liquidity and longevity and legacy, we're just thinking about the whole. We're thinking about the whole problem very, very differently. There are longer term plans. They're much, much more robust. Asset allocation advice has evolved. And so it's hard to imagine that most portfolios could be as vulnerable as they would have been then.
So I'm hearing what Jerry's saying, but I'd like to bring in Johannes as well, because I hear the differences that Jerry's outlined, but the similarities are that in 2008, UBS and other banks were telling clients to put 20 to 30% of their portfolios in alternatives, which were mainly hedge funds at the time. And we're hearing a similar story today, promoting private equity and other private assets. Is that story repeating itself in any way, Johannes?
That's a good point, but I think I want to point out that in public markets you have is it Warren Buffett who said you should sell in greedy times and you should buy in goofy times? And I think he's totally right. You have a much higher sentiment orientation. People have fear, people have emotions, people get greedy in public markets. You don't have that necessarily in institutionalized private markets. And also people also forget, 20% of the recent IPO wave, those are companies that are not profitable. They have not made a dime out there. Whereas if you look in the private space, which is, by the way, 20 times bigger than the public equity space, that's where the hidden gems are. And that's where you essentially have managers who are really good at what they do.
So we're talking about some hidden gems, the mega trends, and a different set of circumstances and emotions applied to private assets. Many thanks to our guests from UBS and to you, ladies and gentlemen, for watching today. We look forward to welcoming you to future PWM and FT discussions on alternative investments and other key topics in wealth and asset management.